Hey everyone, welcome back to Corporate Decoder. Today, AVAV just filed an 8K report detailing a restatement of their previously issued financial statements, and I am seeing a couple of red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is essentially saying that some of their financial numbers from late 2025 and early 2026 were wrong, and they had to fix them. So what happened here is that AeroVironment Incorporated, an aerospace and defense company, which you might know from their drones, found an error in how they calculated some important financial figures. This is a big deal because it means the numbers investors were looking at before are no longer accurate. They had to file this Form 8K, which is a current report, to tell everyone about this problem. The issue specifically relates to their financial statements for the 3 and 9 months ending the 31st of January 2026. This filing happened on the 16th of June 2026, which is pretty recent. The core of this filing is that the company's audit committee discovered an error. This error meant that their previous financial report, a 10Q for the period ending the 31st of January 2026, cannot be relied upon anymore. They are filing an amended report, a 10Q20A, at the same time as this 8K to provide the corrected financial information. This is a serious disclosure, and it suggests there might have been issues with how they were keeping their books. So, where did this error come from? It stems from their Goodwill impairment analysis, which is essentially checking if the value of their acquired businesses, specifically their space reporting unit, has decreased. The problem was in how they calculated the carrying value, which is the book value of that unit. They didn't properly include an allocation of goodwill that was related to acquired deferred tax assets and liabilities. Think of goodwill as the premium a company pays for another company above its net asset value. When this goodwill might be worth less than what is on the books, a company has to take an impairment charge, which reduces profit. This error actually led to an additional goodwill impairment charge. This charge is linked to a pre-existing issue, a stop work order and subsequent termination of an agreement with the US government for certain antenna systems. This event had already triggered an initial look at whether their goodwill was impaired. The restatement is not due to new problems, but rather how these existing issues were accounted for. Importantly, the company states that this doesn't relate to updated estimates of future cash flows, which is a common reason for goodwill impairment. Now let's look at the numbers. These are the financial impacts of the restatement. For the 3 and 9 months ending the 31st of January 2026, their operating loss was actually lower than reported by a huge amount, about $89.4 million. This means they were losing more money from their core business than they initially told investors. When a company's operating loss is understated, it is a clear sign that their core performance was weaker than presented. Consequently, their net loss was also understated by about $87.3 million. This is the bottom line, the total loss for the company. So they were not only losing more money from operations, but their overall loss was also significantly underestimated. This is a pretty substantial correction. And for shareholders, this means the loss per S-share was also understated. They were looking at a smaller loss per S-share than what the corrected numbers show. For the 3 months, it was understated by $1.75, and for the 9 months by $1.79 per S-share. This directly impacts how investors perceive the company's profitability on a per share basis. This error also affected the balance sheet. Their total assets were overstated by about $89.4 million, meaning they had more assets booked than actual. Their liabilities were also overstated by a smaller amount, about $2.1 million, and their total stockholders' equity, which represents the owner's stake in the company, was overstated by about $87.3 million. An overstatement of assets and equity typically means the company looked healthier on paper than it was. This situation also forced the company to reevaluate its internal controls. They found a material weakness in their internal controls over financial reporting. This is a serious finding. It means that their system for ensuring financial reports are accurate has a significant flaw, specifically concerning how they handle goodwill impairment analysis. This directly leads to the conclusion that their disclosure controls, which are the processes for making sure all important company information is disclosed properly, were not effective as of the 31st of January 2026. For investors, a material weakness is a major red flag, suggesting potential future errors and a lack of robust financial oversight. We saw this play out with companies like Bed Bath & Beyond and Rite Aid, where control weaknesses often precede or accompany deeper financial troubles. Now, AeroVironment also provided some updated non-GAAP financial measures. They are trying to show a picture that is potentially better than the GAWAP numbers. Here we have a reconciliation of their adjusted EBITDA, which is a measure that tries to represent operating performance by excluding certain items like interest, taxes, depreciation, and amortization. They are presenting figures that are adjusted for the restatement. Let's look at the effect of restatement column for the 3 months, ended the 31st of January 2026. Their net loss was understated by $87.3 million. This is the impact of the restatement on net loss. Crucially, the Goodwill impairment itself was adjusted by $89.4 million. This is the area where the initial error occurred. The company is saying that their adjusted EBITDA was $44.5 million both before and after the restatement for the 3-month period and $146.0 million for both periods for the 9 months ended the 31st of January 2026. This implies that according to their non-GAAP calculations, the restatement did not impact their adjusted EBITDA. This is a bit of a nuanced point. While the GAAP numbers show a larger loss, their preferred non-GAAP metric, adjusted EBITDA, remains unchanged by this specific restatement. This is something investors should scrutinize, as companies sometimes use these adjustments to present a more favorable view when GAAP numbers are weak. They also provided a reconciliation for non-GAAP earnings per diluted share. For the 3 months ended the 31st of January 2026, the loss per diluted share, as previously reported, was $3.15. After the restatement, the corrected loss per diluted share is $4.9. This is a significant increase in the reported loss per share. The effect of restatement shows an additional loss of $1.75 per share for this period. However, when we look at their adjusted earnings per diluted share, it shows $0.64 per share both before and after the restatement for the 3-month period and $1.42 per share for both periods for the 9 months. This again suggests that their non-GAAP earnings per share metric was not affected by this restatement. This is a key insight. While reported profits and losses took a hit, their adjusted profit metric remains stable. It highlights the importance of understanding what adjustments are being made and whether they truly reflect the underlying operational health of the business. The company states that these non-GAAP measures are presented to provide useful information to investors, offering additional ways to view results and compare them over time. They specifically mention that adjusted EBITDA helps in comparing operating results between newly acquired and existing businesses, and with peer companies. However, they also caution that investors should consider these measures alongside GAAP figures, and be aware that they might not be comparable to similarly titled measures from other companies. This is standard practice, but it is always wise to be a bit skeptical when a company emphasizes non-GAAP figures, especially when GAAP numbers show underlying issues beyond the financial restatement. There is another significant event disclosed in this filing. 2 directors, David Wadlinger and Henry Albers, are resigning from the board. They are stepping down effective the 17th of June 2026. The company explicitly states that their decisions are not due to any disagreements with management on operations, policies, or practices. These directors were appointed in May of 2025 as designees of a significant shareholder, Arlington Capital Partners. This is important because it means their departure is linked to the shareholder agreement. Normally, when directors appointed by a major investor leave, it can signal a change in strategy or a shift in the investor's involvement. The shareholder still has the right to appoint 2 new directors to fill these vacancies. As of the filing date, they haven't named any replacements. The board will now consist of 8 directors. The departure of 2 directors, especially those designated by a major investor, can sometimes precede other strategic shifts or changes in investor focus. So, what is my take on all of this? The financial restatement, particularly the discovery of a material weakness in internal controls, is the most concerning aspect. It suggests a breakdown in the processes that are supposed to ensure financial accuracy, while the company is trying to present a stable picture with its non-GAAP figures like adjusted EBITDA. The underlying GAAP numbers show a significantly worse operational performance than previously reported. This feels like a situation where the company is trying to control the narrative by highlighting adjusted figures while having to admit to serious control deficiencies. The departure of directors tied to a major shareholder also adds a layer of uncertainty, though the company is keen to state there were no disagreements. For investors watching AeroVironment, the focus needs to be on understanding the root cause of these control weaknesses and whether they can be truly remediated. A material weakness is not something to be taken lightly. It's similar to seeing cracks in the foundation of a house. While the company might be able to patch them up, it raises questions about the overall structural integrity. The market cap of $7.7 billion indicates high investor confidence. But this filing is a clear signal that some of that confidence may need to be re-evaluated. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description too.